Hi, yes. Welcome to Moneymanthal TV. Today's topic is NPI loans. We are with CA HANMANDLOO sir. Good morning, sir.
Good morning.
What is NPI, sir?
NPA full form is non-performing asset. It's called NPA, mainly for banking institutions, finance companies. These loans will come non-performing asset loans. This is if a person has taken a loan from a bank or a finance institution, he has not paid the installment for 3 months, means 90 days, or he has not paid the interest for 90 days. The loan will be treated as non-performing asset. This is the RBI Reserve Bank guidelines applicable for all bank loans, loans issued by banks, financial institutions, vehicle finance, housing finance, all these finance institutions. As far as agriculture is concerned, the period is 2 crops. 2 crops generally it will come. 2 crops means 1 year. The loan is not repaid by the farmer. Even after 2 crops, it will be treated as non-performing loan. This is the non-performing loan. The asset is concept used for the lending companies. Lending companies who give loans to others, maybe banks, financial institutions, credit societies, cooperative banks. All these are applicable. That is NPA norms. For agriculture, this is 2 crops, NPA norms. So this is the criteria to understand how the repayment of loans is going on.
And when will be the loan becomes NPA, sir?
If the loan is not repaid, installment is not paid within 90 days, means a gap of more than 90 days, it is called NPA. The installment is 3 installments, means more than 90 days is not paid. This is treated as NPA. And for agriculture, 2 crops.
Okay. How it will be effects for the profits, sir?
So according to RBI Reserve Bank guidelines, if any loan becomes non-performing asset of any bank or finance, they has to write off this loan from the profit and loss account. They have to write off it as an expenditure, and provision has to be created. Based on the Reserve Bank guidelines, they have to write off the account in the profit and loss account. It will be treated as expenditure. So that will reduce the actual profit earned by the banks and financial institutions. Suppose a person is taking a loan, it became NPA. So what has to do, according to RBI guidelines, all these 10 lakhs has to be debited to profit and loss account of the bank.
Okay.
There are guidelines. How much, when is to be written off. 1 year, first year this much, second year this much, third year this much percentage loans are there. And based on that guidelines, they have to write off the loan. First year 20%, second year 30%, next year another part. Some guidelines will change sometimes. Based on that, they have to write off the loan. And the balance sheet it will go out of the balance sheet of the bank, and that will go to stress asset branch of the bank.
Okay.
And it will go different section. So it will not be in the books of the regular banks or financial institutions. So that will affect the profit. Suppose a bank has earned 10 crores profit. The 10 lakhs written off, the 10 lakhs will reduce from the profit. Even though they have performed well, this 10 lakhs will reduce the profit. So that will affect the profit of the banks and financial institutions.
Okay.
So every bank and financial institution wants to see that there are no NPAs. And that will affect their profitability, and that will disclose it to the shareholders, and that will reduce the what we call performance efficiency in the market.
How it will affect the balance sheet, sir?
So once the loan is written off, debited to profit and loss account, written off in the profit and loss account, the loan account will be closed with the balance sheet. So the balance sheet, whatever the balance sheet is after the writing of the NPA, it will become a perfect balance sheet, means true balance sheet. It will be a correct balance sheet. So NPA loan means it is just like bad debt. Just like bad debt is not recoverable, or recoverable may not be recovered after some time. So if the bad debts are included in the balance sheet, it will show unhealthy loans are also included. Means not correct, not standard loans also the balance sheet. That will give the impression that the balance sheet is good. But when these loans, NPA loans, are taken away from the balance sheet, so only the balance sheet reflects the correct loans which are prompt repayment of loans and installments and interest. So that will give the strength, correctness of the balance sheet of the banks and financial institutions. That is what is called, whatever the amount written off to profit and loss account of the bank or financial institution, that will be taken as written off, and that will be reduced from the profits of the bank. It is not waived. Written off is different from waived. Written off means it will go to from banks profit and loss account to from regular business. It will go to stress asset section of the bank. The stress asset management section will look after the legal proceedings of recovery, recovery of loans, sale of assets, and guarantors, properties, everything to be recovered. Stress asset management branch will look after the recovery portion after it become NPA. So this is the way how the loans are written off to the profit and loss account. But it is written off different from waiver. Waiver means it will not be recalled again. Waiver, the loan will not be asked to repay. That is just like we have seen some earlier farmers loans were written off, waived. The written off is different from waived.
Okay.
Some small borrowers loans are waived. So that is waiver means the bank will not ask them back. Will not initiate any proceedings of recovery against such waived loans. But when it is a written off loan, the banks will initiate proceedings, recovery proceedings through stress asset management section of the bank. So this is the process. This is the difference between waiver and write-off. Waiver means it will not be asked again. Means the loan is totally closed. Means that is the last. Waiver write-off means it is temporarily it is taken out from the books of the regular books of the bank or financial institution through profit and loss account or balance sheet, and that will be the proceeding, recovery proceeding will be initiated by the stress asset management section of the branch.
And how it will be understood for the genuine public, sir?
So if they don't understand, see, this is the difference. Write-off is different, waiver is different. Waiver is, it will not be asked again. Written off is, it will be transferred from this section, regular section, to stress asset management section. So this has to be made the difference. We have seen, for some 10 years back, we have seen there are 10.5 lakh NPA loans from all banks. So it means that according to general public, what they feel, 10.5 lakhs has gone from the bank and it will not be recovered. It is waived according to understanding of the general public. But actually, all these 10.5 lakh loans accounts were transferred to stress asset management account of that bank.
Okay.
And that branch will take over. I mean, there will be a branch for 50, 100 branches. There will be a stress asset management branch. That will take initiative steps. They take the loan for all documents and proceedings from this regular bank, and that will initiate proceedings through DRT or NCLT and National Company Law Tribunal, Debt Recovery Tribunal, through insolvency proceedings or through a High Court. Anything required, they will initiate legal proceedings to recover the loan outstanding along with interest. So this is the difference between write-off and waiver.
And what action will be going on NPA, sir?
Every action will be taken by the bank through the Debt Recovery Tribunal, NCLT, National Company Law Tribunal, and this insolvency through insolvency and bankruptcy proceedings that is introduced by the central government in 2016 to look after the recovery of the loans, all these NPA loans of these banks and financial. So this is that will look after that entirely different section, different provisions are there, and that they will take every step to recover last pay also from the borrower or from the sale of assets of the company, from the receivables of the company, stocks of the company, machinery, and guarantors means directors or personal guarantees, and also if any personal guarantee given by some third party also, their assets also will be liable for the repayment of the total loan of the bank. So all these are recoverable initiated by the stress asset management section branch of the bank.
How NPA is sold to ARs, sir?
Now what is happening is many stress asset management branches of many banks are unable to recover the amounts, or they want to get rid of loans. Maybe number of loans may be less, or maybe more complicated. They want to get rid of that loan itself totally. Means they want to sell to asset recognition companies. All these asset recognition companies are recently introduced a concept. So these asset recognition companies are nothing but they'll purchase a bad loan from the bank and they will try to recover initiate proceedings instead of stress asset management of the bank. So ARC will buy the loan account from the bank, and that will take it to that will repay the purchase. Maybe suppose 10 crores loan is there. ARC may purchase for 3 crores, 4 crores, 5 crores like that. And they will pay that 3 crores, 4 crores to that bank. And the ARC company will try to recover this entire loan of 10 crores by initiating the proceedings to recover the loans. These asset recognition companies, these are, we can say, just like bad bank. They'll take
Okay.
only bad loans. They'll purchase only bad loans from banks and they'll recover all the loans. Sometimes they may lose totally, some partially. Sometimes they may recover totally also. So all the powers what have been held with the banks before for NPA proceedings for every bank, those necessary management or bank, all these powers will be gone to ARC, Asset Recognition Company, which will initiate recovery proceedings, initiate steps to recover all the loans outside purchased from the bank.
Okay.
So this is asset sold by bank to ARC, regular bank to NPA loan sold by ARC, regular bank to ARC. ARC will initiate proceedings to recover all these loans. They will be having legally empowered to recover all the loans outstanding which they purchase from the banks, regular banks, to recover from the sale of all assets of the company, guarantors assets, receivables, machinery, everything they can sell until they recover the last rupee.